Hello and welcome back to Alpha Ambition. My name is Jasdeep. Hope all of you are doing really good. In today's video, we're going to be talking about Dividend Stock Investing Strategy. Over the course of the video, we will be busting some of the misconceptions around dividend investing and also discuss some of the pros and cons of investing in dividend stocks. If you're new to the channel, there is a chance that you may have missed my last video where I spoke about the best 5 Canadian dividend stocks. And I also analyzed them and discussed their pros and cons. I would highly recommend watching that video, and also do not forget to like, share and subscribe. Now, dividend stock investing is quite beneficial because these are the stocks that actually give you a certain percentage back in terms of dividends, either monthly, quarterly, or as per their scheduled dispersal cycle. Now, there are various benefits to doing dividend stock investing, so stick around until the end because there's a lot of very important concepts that are coming your way which can help you fine-tune your investing portfolio. So when you think of dividend stock investing, you may think, okay, there's a regular stream of dividend that comes in, and as my portfolio grows, the size of the dividends will also grow. And probably at some point in time in your life, maybe at 45, you're sitting on a beach sipping your margarita and you may have early retired because there's a consistent income stream coming your way, which is through the dividends. Well, that is definitely possible, but hold on, it's not as simple and glamorous. So here are a few things that you should definitely keep in mind when you're picking a dividend stock. Well, first and foremost, you need to know your investing style and also your risk appetite. Buying a dividend stock is like buying any other stock. So you need to ask yourself whether you want to buy an individual stock or you want to spread your risk by having a bucket or a basket of stocks, which you can achieve by investing in an ETF. Now, there are upsides to holding individual stocks. They give you higher reward, but that also comes with higher risk. In comparison, when you invest in an ETF, there is definitely a trade-off in terms of the reward. You may not get as high of a reward, but at the same time, you're also minimizing or spreading your risk over a variety of stocks. Well, one downside of getting an ETF is that you may be paying expense ratio on that ETF, which is obviously going to eat into your returns of the portfolio. Second very important thing is the health of the company or the stock that you're investing in. You should definitely check what has been the historical dividend payout pattern of a stock. Is the company financially stable? Have they steadily increased or decreased their dividends? And so on and so forth. While none of these aspects can guarantee you what is going to happen in the future, but they give you a reasonable estimate of how the company has been doing in the recent past couple of years. And as we've seen with a lot of dividend giving companies, the past pattern does really matter because the companies that may not have been paying dividends as consistently, or they have reduced their dividends over the period of time, they may be financially unstable and may be finding it challenging to paying out dividends on a regular frequency. So definitely do your due diligence in terms of understanding whether the business or whether the industry is growing or not. Third is the illusion of high dividend yield. Now, in the last video when we were discussing the list of top 5 Canadian dividend stocks, we definitely leaned at those stocks which basically give a high dividend yield. Now, before you start Googling around all the companies which have really high dividend payouts, let me warn you that this may not be the right strategy. Let's say the stock value is $100 and you get a dividend of $4 in a full year, then the dividend yield is 4%. Now, you want to avoid those companies where the dividend yield has gone up considerably in the last couple of years. Now, this may be because the stock price has decreased. Now, again using the same example, let's say the stock price has basically fallen from $100 to $50. Now, if the company still pays out $4 as dividend, now the dividend has risen from 4% to 8%. Now, in this case, while the company has maintained its dividend at $4 per year, the company stock is clearly tumbling. Now, you really want to avoid that kind of stocks, which basically takes me to another key terminology used to analyze dividend stocks. It is the dividend payout ratio. Dividend payout ratio, as I explained in my last video, is basically the percentage of the total earnings in an annual year that the company pays out as dividend. Now, if the dividend payout ratio is too high, it may suggest that the company may not be able to service its dividend in the future. Because if anything happens to the industry overall, the company may not be able to service its dividend. A decent percentage for dividend payout ratio should be between 10% to max 30%. Anything beyond that, it should raise a suspicion that how will the company be able to pay this big of a dividend payout if anything goes wrong with the company. Last but not the least, you can also do a couple of more things. I know it's going to take a bit of effort, is looking at the balance sheet of the company and seeing what is their debt ratio. Is the debt on the company increasing over the period of time? If the earnings are also increasing, that is okay. But if they're not, that may be an alarming situation. Now, another very critical point that you should keep in mind is taxes. Depending on in which account you're keeping your stocks, dividends are also considered an extra income, which means that they will be taxed. On a highly generalized level, tax treatment on capital gains is relatively better than the tax treatment on dividends. But I would definitely suggest that do discuss this with your tax consultant if large portion of your stock holding are the companies that give dividends. Second last on my list of cautions is do not obsess too much over the dividend stocks. Focusing too much on dividend stocks can actually be counterproductive for your overall stock portfolio. That means you're heavily relying on individual stocks that give good dividend yield, and you may not be diversifying your stock portfolio as optimally. If your stock portfolio is relying heavily on a couple of big stocks, then anything that happens to those particular stocks can ruin the returns that you have garnered over the period of so many years. And last very important tip that you should always keep in mind is do not let the dividend that you get from a particular stock just sit as an idle cash in your account. Please do reinvest your dividends back into buying probably the same stock or any other stock that you want to buy. That way you're putting a very powerful concept of compounding into action. Because now that your stocks have earned dividend, if you reinvest it back, that portion of money is again going to give you dividends and stock appreciation. And if you keep doing this cycle, and it's going to compound over the period of year, and that's magic. Now that we've discussed some of the cautions related to dividend investing strategy, it's time to discuss some of the positive sides of it. There is a misconception out there that dividend stocks particularly are for older people or it is for a risk-averse investor. Well, that's not the case. You should definitely have a portion of your stock holdings investing into stocks that give dividends. And that's ideal for long-term investing strategy. Because usually what we have seen in the stock market in past so many years is that the companies that provide dividend are inherently financially stable companies. There may be exceptions to this, but you can imagine that financially unstable companies will not be able to pay dividend to start with. As per historical patterns, even during the periods of recession, dividend stocks have historically shown growth. And did you know 75% of the returns from S&P 500 companies between 1985 and 2019 have come from dividends? Now, if you don't believe me, you can ask Warren Buffett for sure. Another positive of investing into dividend stocks is that it'll help you balance the effect of inflation. Now, if you have a stock which has given you an unrealized capital gain of 2% over the period of year, then the stock has actually given you no return at all because the inflation in that period would have been actually higher than 2%. So for your stock to actually give you any kind of tangible return, it has to first beat the inflation. And dividends from a dividend stock actually help you do the same. Because if the company is giving 3%, 4% or 2% in terms of dividends in the course of a full year, then it has managed to at least beat the inflation, and then whatever you get in terms of the stock price growth over the period of 1 year is basically your actual return. And last but not least, if the stock that you've picked provides an average to a high dividend yield, it is at least better than the interest that you will earn in savings account. But one caveat here is that you should have firstly invested in a company which is relatively stable, which means the probability of the stock tumbling or increasing rapidly is as low as possible. Now that has been all the pros and cons, the positive and negatives, and busting of the misconceptions that we had to do for today's video. Here's a quick summary of what we discussed today. And with that, I'm gonna sign off for today. And in case you have any questions, any clarifications, you please do mention that in the comment section below. It gives me a lot of joy when somebody posts in the comment section about any specific topic that they want me to make a video on. I'll be really happy in making that video in the future. In the meantime, please do not forget to like, share and subscribe, and I'll see you in the next video. Bye bye and thank you.